Our housing and climate change crises are taking a tremendous toll on everyday working people. Following years of heavy losses from climate-exacerbated natural disasters, insurers in states across the country are raising rates and pulling out of markets altogether. Just this week, Farmers Insurance announced that it will pull out of Florida. In Louisiana, 11 insurers have gone bankrupt in the last 2 years and 10 have left the state. And this is just the beginning. This problem will continue to grow worse each year, each decade, until the climate crisis is mitigated. This hearing also comes at a time of unprecedented housing unaffordability and homelessness. In 2021, the number of tenants with unaffordable rents reached an all-time high, with 49% of U.S. renters paying more than a third of their income on rent. Although homeownership is still a goal for many, it is increasingly unattainable when high rents hamper the ability to save for a down payment and home prices continue their meteoric ascent. In terms of factors influencing insurance prices, with the exception of the National Flood Insurance Program, insurance is regulated at the state level, and our states are home to a broad diversity of political viewpoints. Some, like California, have adopted more stringent consumer protections, such as procedural limits on rate increases, while other states, like Florida, have passed anti-ESG laws. Yet, insurers are raising rates and withdrawing coverage in both of these states, which indicates that ESG is not the main driver of insurance unaffordability. So what then is behind these price increases? First, obviously, climate change is contributing to increasingly frequent and severe natural disasters. This has translated into massive, often unsustainable losses for insurers. Climate change is, in effect, upending the risk calculus that our insurance system has been based on. Second, reinsurance rates for catastrophic property coverage have greatly increased in recent years. July reinsurance renewal costs have increased, that's this July, by 30 to 50% for some U.S. policies. The reinsurance market is global and unregulated, meaning that we have little to no control over their rates or what they do. Third, unsustainable land use practices. Too many states and localities continue to permit or even encourage new housing construction in disaster-prone areas. These problems are obviously very complex, and there is no one simple solution. This really requires many agencies and levels of government acting in tandem to truly meet this challenge. First, we need to support climate financial regulatory efforts. Financial regulators and institutions must manage and mitigate climate financial risks. Many lenders and insurers are contributing to the climate crisis by internalizing short-term profits through their investments in risky, carbon-intensive industries, while externalizing the costs onto their consumers and ultimately withdrawing when the physical climate risks get too high. We must also improve insurance data collection. Right now, we don't even have access to the data necessary to understand insurance trends on a national level, which is why we support the Federal Insurance Office's limited data request for zip code level data on homeowners insurance policies, and urge the office to go further in seeking more granular data. We should consider developing a public reinsurance program for states. Reinsurance price increases are a major driver of insurance pricing, and a public reinsurance program could allow states and communities to opt in exchange for agreeing to consumer protections and limiting or ending development in hazardous areas. We must support climate resilience communities. The IRA provided a large amount of federal funding to make our homes more energy efficient and climate resilient. FEMA also has hazard mitigation grants and buyout programs, and these resources are deeply needed, and we'll need more of them just to meet the current demand. We need to support states in lowering disaster losses by limiting or ending new development in hazard-prone areas, investing in climate-resilient infrastructure, and requiring insurers to provide premium reductions when property owners undertake home hardening improvements that will improve their vulnerability. And while my testimony has mostly focused on insurance, with regards to housing, we should require tenant protections on FHFA finance properties and crack down on private equity abuses.